way of holding family wealth. Are you seeing a lot of these being used?
Yes, they definitely have become more popular in recent years. I think the first message to tell people is that they're just a simple corporate structure, albeit with the shareholders as family members, that allow for a kind of flexible accumulation of wealth with asset protection, and the ability to distribute profits among family members.
Yeah, so why do you think that is then, that people are now looking at companies?
I think there's two key reasons. One, the changes to the taxation of trusts.
Yeah.
10, 15 years ago, back in 2006, they've become far less attractive for holding family wealth for a variety of reasons. Also, and perhaps more importantly so in recent years, is the diversion of tax rates between income tax for trustees at up to 45% at the moment, and corporation tax for companies, which is currently 19%, but due to reduce next year to 17%, as you know. This has provided a further incentive to incorporate investment businesses and therefore accumulate wealth at much lower tax rates.
Okay. So one example, and quite a straightforward example, would be that someone's got some cash that they're looking to invest. They want their family to benefit either from income or from capital growth, and they can use a company vehicle to achieve that.
Yeah, I agree. Typically that might happen on, following the sale of a business, for example. Actually though, it doesn't have to be a straightforward situation like that. We do get clients who have, existing investment businesses, typically property businesses, but not necessarily, who are looking to transfer that business into a limited company with similar benefits and take advantage of the corporate tax regime. I think the first thing to explain to clients often is the difference between how a company is taxed compared to how they would be taxed personally on their investments on an ongoing basis.
Yes, so obviously you've got the difference between the dividend tax that an individual would pay on receipt of a dividend, whereas a company corporate tax structure would normally not pay tax at all on dividends they're receiving. You've also got more favourable rates of tax. So corporation tax, as you know, is charged at 19% and 17% on income and gains. Obviously individuals pay tax at much higher rates on both of those.
The other advantage, of course, is that typically you can get more relief for expenses in a limited company than they could individually, particularly for investment businesses. So a couple of examples would be an investment business could typically claim relief for investment manager fees, for example, which individuals certainly can't. And in terms of property businesses, full relief is available for property businesses, whereas we know that following the changes recently, the mortgage interest relief available for individuals has been restricted to the basic rate relief.
So in summary, really, we're talking about lower tax rates and better reliefs, leaving more tax for reinvestment and accumulation in the family.
The other thing we need to think about, of course, is how families extract money from their family investment company. The structure offers a lot of flexibility, and typically the founders can extract cash as a repayment of a director's loan from when the company's set up, and we'll come to that shortly. There's also the option of paying dividends, and typically there'll be different classes of shares, so different dividends can be paid to different people. One significant advantage of a family investment company over personal investments is the ability to pay employer pension contributions for the directors or employees of the company. Typically they'll of course be family members. The pension contributions will normally be tax deductible for the company, and will be tax-free benefit from the individual. Now, as you know, I'm a big advocate of pension savings because of the associated tax reliefs, but of course that's a different subject altogether.
Okay. Right, so far we've talked about the ongoing tax. Obviously the main motivator and driver for people setting up family investment companies is usually inheritance tax. So as opposed to with a trust structure, you don't have these 10-year anniversary tax charges within a family investment company, and also you're not limited by the amount you can put in initially by triggering a 20% lifetime tax charge.
Let's look at an example. Take a simple case where a client has some cash to invest. They might set up a company as follows. They might have ordinary shares for themselves, let's say themselves and their spouse, and a separate class of ordinary share for their children, typically adult children. Now the fact they've got different classes of share would allow them to pay different dividends to each of themselves and their children. The other benefit, if you like, of different classes of shares, you might have different rights assigned to those shares. So you might have one class of share, typically the founder's shares, that contain some or all, possibly, of the voting rights to give them control or to let them retain control. But actually you might have the capital growth accruing to the children's shares. the clients may fund the company initially with a director's loan, which can be really, really advantageous. The company then owes them money. So as the company makes profits, it can repay that loan without any income tax. The other benefit of this is because that loan remains an asset in the founder's estate, actually as that loan is repaid, the capital in their estate, which is otherwise exposed to inheritance tax, is gradually reducing as they're spending it to fund their lifestyle. The other thing you can do with the loans, or rather the founders might actually choose to make a gift of the loan that's due to them from the company, and after 7 years the value of that gift would fall out of their estate for inheritance tax. In summary, family investment companies are a really efficient vehicle for holding investments for a number of reasons. Not only the ongoing tax advantages, but the inheritance tax and succession planning opportunities that they present. The other thing to remember is that actually they're really flexible, so the structure can be flexed depending on the client's particular circumstances.
And it still allows that element of control as well for the parents or the donors. So it's clearly why they've become so popular.